Hi, everyone. Greetings and blessings for you. And I welcome you all in my session on IFRS 9, the requirements for measuring the financial assets and the financial liabilities. Myself, Ahmed Farhan, and our today's agenda is to discuss the financial instrument, that what is this financial instrument? In fact, its recognition criteria, I'll talk a very little about it. And then the basic concept that we will be discussing in our today's session, that is about the measurement methods and classifications of the financial asset. And we will also discuss about the measurement of financial liabilities. In order to understand that how do we classify the financial assets, we must understand the business model and cash flow characteristics test, the contractual cash flow characteristics test. And we'll also talk about the classification and reclassification of the financial assets. So when we say financial instrument, in fact, financial instrument is a contract that gives rise to the financial asset of one entity and financial liability or equity instrument of another entity. So if a contract does not give rise at the same time to the financial asset of one entity and the financial liability of the other entity or the equity instrument of another entity, it means that is not a financial instrument. It is a must. Just to understand with more clarity, we can have few examples as we see that in the sales of goods contract, in the seller's entity, you will find financial asset, which is the trade receivable, and the buyer's balance sheet, you will find a financial asset, financial liability, which is the trade payable. In the same way, when we issue share capital, that share capital is equity instrument, and the person who buys or the entity who buys or holds that, it is a financial asset for that. Same goes with the loan agreements and loan notes. So, in fact, yeah, by the way, on the same slide, we also see the secondary financial instruments, which are the derivatives. Mainly financial instruments, which are the primary financial instruments, they at the same time give rise to the financial asset and financial liability, but these are secondary financial instruments, which are the derivatives, which do not carry their value in itself, but their value depends on some underlying. These are the forward contracts, future contracts, swap contracts, options. So how these are accounted for, I will talk a very little on it when I will be discussing the recognition. Because in this IFRS 9, unlike the other standards, the recognition criteria is different. You must be knowing that for almost all the financial information, the recognition criteria is the same as discussed in ISB conceptual framework, where the probability of the inflow or outflow of the economic benefit belonging to such asset or liability or income or expenses seen, plus the reliable measurement of the value associated to that is worked out first. But in the case of financial instrument, the criteria is altogether different. IFRS 9 says that if the entity becomes party to the contract, at the same time, it should recognize the financial asset or financial liability in its financial statements. So it is very unlike, because we don't have any value with us. We don't have even the probability of inflow or outflow of the economic benefits. Just the entity has become party to the contract. In fact, this is the main reason which covers the accounting treatment for derivatives. Because in derivatives, we see that the party does not have any value that we can associate to the forward or the future or the swap, or even in some cases option, although a very nominal value we see in option, especially in forward contracts, we don't see any value associated to that derivative. But even then, we have to recognize that zero value a financial asset along with a zero value to the cash in credit. So what happens that this gives a confidence to the user of the financial statement that the entity has entered into a contract and that contract has been recognized, which is a derivative contract, and such will be remeasured on the reporting date at its fair value. So for that reason, its recognition is a must. So this is why, like, the recognition of financial asset and liability is made when the entity becomes party to the contract. Now comes the main area on which, in fact, our webinar is focusing today, that is measurement of the financial instruments. Okay, before talking about the initial measurement and the subsequent measurement, I just want to make this clear that there are two methods which will be discussed in IFRS 9 for measuring the financial assets and financial liabilities. And these are amortized cost method and fair value method. Amortized cost method is the method which is based on effective interest rate. In this, we allocate the financial income or the financial expense, means interest involved in that financial instrument, using the effective interest rate. Question arises, what is this effective interest rate? Just to understand very easily the concept of effective interest rate, we can relate it with the IRR. So I mostly used to analogize this EIR with IRR. Or you can say that there are triplets: EIR, effective interest rate, IRR, internal rate of return, and IRI, interest rate implicit in lease. All these three are in fact giving same meaning. That's why I'm calling triplets. And what are those meaning? That this is a rate when used to discount the future cash flows, the present value or the discounted cash flow will be equal to the fair value on the date of transaction. Exactly the same concept of IRR, we will look into this EIR, effective interest rate. So this effective interest rate is used to calculate the interest income or interest expense. So the next question arises, how to calculate effective interest rate in the same way as we calculate the IRR The only thing that you have to carry in your mind is that IRR we use to appraise the projects. IRI we use to work out the leases, and EIR we use to work out the financial instruments. This is the only difference you can say. Let's have an example over here that the loan was advanced by a bank of 1,000 for 3 years and the coupon interest rate was 10%. This 10% is the coupon interest rate, which was payable annually. And at its maturity, the bank is saying to the borrower that you would be paying me 1,200 at the time of its maturity. So effectively, you cannot say that the interest rate is 10%. The interest rate is in fact greater than 10% because 10% gives you 100 and that borrower is paying 100 each year. But even then the bank is saying, I need 1,200. So that 200 that the borrower will be paying on maturity will also be considered as interest. So in total, it is paying 500 as interest in 3 years time period. So for that reason, we will be working out the EIR by using hit and trial method, by using financial calculator, by using Excel formula. So the fair value today is 1,000 and the future cash flows are 100, which is 10% of the 1,000 coupon rate, the cash flow that the bank will receive after 1 year. After 2 years, it will receive 100 again. And after 3 years, the bank will receive 100 plus 1,200, 1,300. So this is the future cash flows when we will discount it at 15.72, which was calculated as EIR. We see that our present value is exactly equal to the fair value on the date of transaction. So it's proof that it is an IRR, in fact, the internal rate of return of such security. So how we use it? The bank has advanced 1,000. This is recoverable. On that 1,000, which is the face value, 10% is the interest. 100 is the amount of interest that it will receive in cash. But IFRS 9 says the interest income should be worked out based on EIR, effective interest rate. So the difference between the effective interest and the interest received will be added in the loan receivable amount. Each year, you will do the same practice, and final cash flow from the borrower, the net value will be nil. So you are done with your work. So the difference between the principal amount and the amount that the bank will get at maturity, along with the interest coupon rate calculated based on the coupon rate, is spread evenly, or not evenly, you can say spread using a constant rate over the loan term. So this is known as amortized cost method using EIR. The accounting entries are pretty much easy to understand. Loan receivable, debit, cash, credit, you would be receiving cash 100, income 157. The difference is taken to receivable. Again, cash 100, income 166. The difference is taken to loan receivable. Again, cash 100, 176. Based on EIR, difference is taken to receivable. So the receivable is inflating by the time with the difference of effective interest and the coupon interest, and then finally it will be received in cash 1,200 on maturity. This is the simple accounting for this. So after having the knowledge of amortized cost method, now what is fair value? So it is very easy to understand to all of us that it is based on IFRS 13, which is about the measurement of fair value, which says that fair value is in fact an exit price. Fair value of an asset is the price at which the asset can be sold, and fair value of a liability is the amount at which the liability will be transformed in an orderly transaction among the market participants on a measurement date. So this is the definition of fair value as per IFRS 13. So fair value is not something that you will be saying that you are forcing someone on a certain value. Okay, it is not the amount received or paid in a forced transaction and in voluntary liquidation. It is used to make buy, sell, hold decisions. So fair value for assets and financial liabilities, when we look into the market, you see two prices appear over there, buying and selling. So the buying price from the market perspective and the selling price from the market perspective. The market will be selling at a price to the buyer. Supposedly, you are the entity, you are buying something from the market, you would be given an offer price. Okay. And when you would be selling, you would be selling at a bid price that I'll explain a little later. So by the way, the financial assets are measured at bid price and financial liabilities are measured at offer price. Okay. So the offer price is in fact the selling price, which is normally greater than the bid price, which is normally lesser. So this buying and selling from the market perspective. So where there is no market, the price of the most recent transaction in the market is taken as fair value, and valuation techniques that are consistent with accepted methodologies like DCF, etc., and include all relevant inputs, mostly future expected cash flow discounted at current market yield. So those techniques will be used. This is what like we see in IFRS 13. Now comes how to measure the financial asset and financial liability at its initial recognition. IFRS 9 says at initial recognition, again, it is unlike from the usual standards. There are a few more standards who give the same criteria or same requirement is there for initial measurement, but only 2 or 3 standards. IFRS 9 says that initially the financial instrument should be measured at fair value, except the trade receivables or the receivables arising from IFRS 15. Now see, what we do for trade receivables and contract assets, which originate in fact through IFRS 15, their measurement is worked out based on IFRS 15, their transaction price. Okay. So that is not taken over here in IFRS 9. IFRS 9 talks about the initial measurement for all other financial instruments, means for all other financial assets and financial liabilities at fair value. Now, there is a small tricky point that we need to focus. The story of egg and chick. Although we are talking about the initial measurement, but we have to keep in our mind the subsequent measurement also at this point in time. Why? To do recognition of the transaction cost. So the concept is, whenever we will enter into a financial instrument, we would be paying some transaction cost, say commission or broker's fee. That transaction cost should be recognized on the same time when we are recognizing the financial instrument. So when we are recognizing a financial asset, which will be subsequently measured at fair value through profit or loss, the related transaction cost will also be recognized in profit or loss. And all other transaction costs related to all other financial assets and financial liabilities also will be capitalized. So I'll elaborate this thing in the next slide. Means after this is what like I have already discussed about the IFRS 15. So come up over here in this slide, you will see that what in fact the accounting treatment we do for the transaction cost. Just focus on the 3 rows at the bottom of this slide. There is a financial asset which will be measured at fair value through profit loss. What is the criteria? That I will discuss later. I just told you that this is the story of egg and chick. What comes first? So the thing is that at the initial measurement time, we need to understand that what will happen in the subsequent measurement. And now how that subsequent measurement will give a criteria to measure it, like at fair value through profit loss or fair value through OCI or amortized cost method. That's something we will discuss later. But as of now, we will just carry this concept that if subsequently the financial instrument will be measured at fair value through profit or loss, its related transaction cost will be charged to profit loss. So financial asset debit, profit loss debit, cash credit 110. But if subsequently the financial asset will be measured at fair value through OCI, its transaction cost will be capitalized, okay? Or through amortized cost method, its transaction cost will be capitalized altogether. The financial asset debit cash credit. Capitalized means that will be added in the cost of that financial asset. Now comes the financial liability. So the financial liability, which will be measured at amortized cost method, subsequently, its transaction cost will be subtracted from the value of that financial liability on the transaction date. Reason, supposedly you have taken a liability of 100, cash debit 100, liability credit 100. What accounting you will pass for the payment of transaction cost? Obviously, you will credit cash and debit the transaction cost. Such transaction cost debit will be subtracted from the financial liability. So the financial liability will be credited with 90. This 10 debit of the transaction cost is reducing the value of the financial liability on that transaction date. And the cash is at net of that 10 transaction cost. So it is 90 debit and 90 credit. So this is known as capitalization. The last 2 rows are capitalizing the transaction cost, and here we are expensing out the transaction cost when it would, the financial instrument would be measured at fair value through profits. Okay. This is also very important point and interesting too. The difference between bid and offer price, as we just discussed, that there would be a difference. Offer price would usually be greater than the bid price. So the difference, how we have to treat it. The concept is, that when you buy a financial asset, obviously you would be paying offer price, which is greater. You cannot measure your financial asset at a price different from the fair value, which is the bid price. Bid price is the exit price. Let me take you through an activity which will make it easy to understand. The bid price is 100, which is the fair price, and the offer price is 102. The entity has paid 102 for buying the financial instrument, and the broker's fee is 3. So if the entity will be measuring this investment at fair value through profit or loss, what will happen? The financial asset will be debited with 100, cash will be credited with 105, and the difference 5, which includes broker's fee and the bid offer difference 2, means 3 plus 2, 5 will be taken to statement of profit loss. But if the investment is to be made at fair value through OCI or amortized cost method, that 5 will be capitalized. Okay. So this is how we work out the transaction cost. Now comes the point that in subsequent reporting dates, subsequent to the initial measurement, how this financial asset and financial liability will be measured. So as we have already discussed, that there are 2 methods, fair value and amortized cost method. And that fair value through profit loss is another method, and fair value through OCI is a separate method. Yeah, I just want to make one thing clear, which the accountants must generally understand. What does this fair value through OCI mean? Might be you would be having a clear concept of it, but mostly I see people are confused on it. The fair value through profit or loss is fine. The difference will be taken to profit loss. But fair value through OCI doesn't mean that in fact the difference we are taking to OCI, it means the difference we are recognizing in the equity through the corridor of OCI. Remember this thing. The difference is recognizing equity through the corridor of OCI. We just present that in the corridor so that comprehensively we are having a full amount of income or profits with us. The income or the profits that we generate from our operations, statement of loss, and the other comprehensive income, which in totality will make the income comprehensive. Okay, so that's why it is just presented over here, whereas the debit and credit effect is concerned, the debit effect is in the financial asset and credit effect is in the equity. This is its debit and credit. This is just a corridor. So remember this thing. It is very important concept that we should be 100% clear on. Wonderful. So when we are using these methods, we say that we are classifying our financial assets, and these methods are used to classify the financial assets into the different categories. So the beauty of this IFRS 9 is that the classification is based on the measurement methods or measuring methods. We use, in fact, a business model test and contractual cash flow characteristics test. Based on these 2 tests, we finalize the classification in which such financial asset will be categorized or grouped. So in the upcoming portion, I'll be discussing with you the business model test first and then cash flow characteristics test. So in order to understand the business model test, these three I'll discuss with you at once, and then I'll discuss with you certain points about the certain business models. Hold to collect and sell, and hold to trade. The thing is that when we say hold to collect, it means that we are talking about investment in debt instruments. Again, in fact, might be you would be knowing, and it is very much easy concept, but still I always take my audience as if there are few beginners are attending the webinar. For them, when we say investment, we do investment in equity instruments, or we do investment in debt instruments. In fact, this is investment in financial instrument, okay? So that financial instrument in which we means the entity is doing investment, that would be either the equity instrument or the debt instrument. When we are saying equity instrument means the equity share issued by the other entity. And when we are saying we are investing in the debt instrument, it means the debentures or the bonds or the loan stocks issued by the other entity. We are making investment in those. Having said that, these three business models, what you are reading on the slide, are about the investment in debt instruments. Now you will be 100% clear on the concept of hold to collect. When you make investment in debt instrument, in a loan notes, what you are in fact focusing on, receiving the interest on the principal and ultimately to get your invested money back. So the contractual cash flows you are focusing on, you will hold that investment till its maturity, and you would keep on receiving interest, which is the contractual cash flow, and the principal amount again, which is the contractual cash flow. That could be principal plus premium as well. Okay, as we have just discussed an example that at maturity, the bank asks for the premium to pay. So that is again based on a contract. So hold to collect. Remember, this is a business model. This is not something associated to an individual investment. When we say business model, keep supposedly a bank in your mind. What is the business model of a bank? Bank advances loans to the borrowers and keep that contract with itself till its maturity. It does not sell that contract to some other person or transfers the contract to some other person. It keeps that contract with itself and keep on receiving the contractual cash flows from the borrowers till maturity. It is the business model of collect, hold and collect. Then there is another model, which is hold to collect and sell. This is the model in which the entity will hold for some period and will keep on receiving the contractual cash flows for some period, but the entity is focusing on an opportunity to sell that asset if it can receive a better value. So that advancement or that investment was not made with the intention to hold that portfolio till maturity. It is hold to collect and sell. And the third one is hold to trade. It is just a trading. You bought that investment to even sell overnight. Okay, so in very short run, you would be selling it out. So that is a trading. So these are in fact the three models. By the way, there are few points in which we have to focus on hold to collect thing, because this is in fact the base to select the category or classification in which the investment is measured at amortized cost method subsequently. So the standard says that why we are saying hold to collect, because we have focused on the past information. The business is not selling its assets in the short term. The business keeps its assets itself till maturity. And there is no expectation that in the future it will be selling it out. So this is how, which will determine the model of the business which is making investments. So the business model test is the factual assessment that is based on how assets portfolio are managed, not an individual asset. Means the investment is an individual asset with us. We will not look into one of the investment that how it would be handled. Rather, we will look into the portfolio or the whole scenario in totality for that business, as I gave you an example of a bank. So typically observable through the activities that the entity undertakes. For the bank, as I have told you, it's very easy to understand, and anchor in how the cash flow is related about it. Cash flow is like basically the contractual cash flow that the entity will be receiving back in terms of interest on investments, and finally the principal amount of the investment. So the objective of entity's business model is to test that whether the financial assets are held to collect the contractual cash flows or to sell prior to its maturity. Okay. So the assessment of business model test is in fact based on the judgment, and it is not determined by a single factor. The suggested evidence, which include like how the performance of the business model and the financial assets which are held within that business model are evaluated and reported. How that performance would be. Means when we say performance, means like the performance of the business is that it is managing its assets through the fair value or by promptly collecting the recoveries. So this is the performance of that business. Risks associated to that business model as well as risks associated to that financial asset, how those are managed and how the managers are compensated. So these are few criteria that we look into, and based on those, we then judge that this business is holding the investments till maturity. So it is hold to collect. And one more thing, very important area. It is like sometimes what happens, there is a stressful situation. In that stressful situation, the business deviates from its model and sells few securities to come out of that stressful situation. So the standard says that if some business is taking decision to come out of a stressful situation and selling it out, its investments, it doesn't mean that the business model has changed. Okay, so the business model will be looked into at its normal situation or the situation which is reasonably expected, okay, not in a stressful or worst case scenario. There's an example in which we see that the business model is changed. Like an entity has a portfolio of commercial loans that it holds to sell in the short term, means for trading purposes. It is holding for trading purposes. Your entity is holding investments for trading purposes, and the entity acquires a company that manages commercial. Your entity has acquired a subsidiary, and that subsidiary is managing commercial loans and has a business model that holds the loan in order to collect the contractual cash flows till maturity. The original portfolio of commercial loans is no longer for sale, and its portfolio is now managed together with the acquired commercial loans, all the loans held to collect the contract. So here the business model is changed. So yes, business model can be changed. And there is an example where business model is not changed. The scenario is that the entity, your entity, changes its intention for a specific financial asset in the circumstances of significant changes in the market conditions. The market conditions are changing, and because of the change in the market condition, it is changing its intention regarding the hold to collect or hold to collect and sell or hold for trading purposes. For example, a particular market for financial assets has temporarily disappeared. So what happens? That this is not, in fact, a change in business model. This is a temporary situation which will be reversed by the time. So next test is cash flow characteristics test. In this, we in fact focus on the contractual cash flows. We focus on the characteristics of the contractual cash flows for which the business model was to collect till maturity. So the thing is that this contractual cash flow is in fact the SPPI, means solely the payment of principal amount and the interest on the principal amount, SPPI. If it is so, it means the test is qualified. If it is not, it includes some other fluctuations, then it is not the test that you can say is passed. So assessing the cash flow characteristics also includes an analysis of changes in the timing or in the amount of the payment. Yes, it can be there, but timing and amount change doesn't mean that the SPPI is not there. Okay. So it is important to assess whether the cash flows before and after the change represent only the repayments of the nominal amount and the interest. Okay. So if the timings are changed because of a modification, the timing of the interest payment is changed, but the interest payment remains the same and the principal amount remains the same. Only the timing or amount, which is like bringing some change, but that is still the SPPI. So the SPPI characteristics means, number one, the principal, which is the fair value of the financial asset at initial recognition. Okay, that 1,000 in our example, that amount which was transferred to the holder, to the borrower. And the interest, in fact, is the consideration of the time value of money, the basic lending risks, which the lender is seeking, in fact. Risks associated to the lender are the credit risks. That might be the borrower would not be able to repay the money, or it would not be able to collect the amount advanced. And other associated costs, for example, administrative expenses and the profit margin. So all these are put into the interest element and then asked, because end of the day, it is a business of that in that financial institution or a bank or an entity. It has to make profits. It has to meet administrative expenses. It has to take care of the risks associated to that investment, and it has to look into the time value of money. So all these things are in fact considered to work out the interest rate or the interest amount. So that interest amount and the principal are in fact the contractual cash flows. There are certain other variables uh, uh, which, like contractual cash flows, are consistent with some basic lending arrangements. For example, are there any other variable affecting the cash flows? For example, returns based on bonds, issuers' activity, or other factors like profit participation? You would be having this concept with you, participatory debentures or participating debentures or bonds. What are those? Those would be participating in the profit or in the net assets of the entity. So if the bond or debenture is participating in the net assets of the entity or will be receiving a percentage out of the profits, it means it is not the characteristics of SPPI. And convertible bonds and participatory debentures do not meet the SPPI characteristics, by the way. So there are few contingent events in which we see that the interest rate gets changed. For example, there is fixed interest rate and fluctuating interest rate. Fluctuating is LIBOR plus 2% or 3%, whatever. If there is a contract that the rate would be LIBOR plus 2% and LIBOR gets changed, obviously the interest amount will be changed. So the entity must determine whether the contractual cash flows that could arise over the life of the instrument due to the contingent event meet the SPPI. For example, non-financial institution holds a bond which pays LIBOR plus 2%. The contractual provisions of the instrument establish that if the issuer credit rating changes, the interest rate of the entire instrument will be revised to LIBOR plus 3%. So it will remain the SPPI because it is a contingent event which is already mentioned in the contract. There is one more very important concept which is associated to SBPI. That is the concept of appropriate compensation. Sometimes what happens that early payment penalty is imposed, or if the borrower seeks extension, again a penalty or a sort of compensation is imposed to the borrower. Should that be taken in SPPI? Means should that be considered as a contractual cash flow? So what happened in October 2017, ISB clarified it that it is a negative item, means it should be considered as the part of SPPI. I have put an example on it. There is a scenario, supposedly. Sample bank lends fund to a borrower. You are a sample bank. You lend to me, suppose I'm a borrower. And the early payment option is there. The agreement includes an early payment option, okay, through which the loan can be repaid earlier than the loan term. If the borrower exercises the option, it must repay the outstanding principal amount plus an interest that has accrued plus a compensation fee for the early repayment. Should that compensation fee be included in SPPI? Yes. This is what the earlier slide was saying. Then extension option. The agreement includes an option of extension of loan term upon payment of a fee for extension. The other terms of the loan agreement remain the same with the same interest rate and principal amount. So in both the cases, the instrument falls under hold to collect. Means there is a contractual cash flow which is like collected by the lender. So when hold to collect is there, we'll see till maturity or before maturity we are selling it out. So if it is till maturity, amortized cost method will be used. If we will hold to collect and sell, even then contractual cash flow is there, we will use fair value through OCI. I'll discuss this in the next upcoming slides. Classification based on this business model and contractual cash flow characteristics. So it will give you a clarity about the classification. So the test is business model and contractual cash flow characteristics test. The business model is hold to collect and sell, or hold for trading, or hold to collect. If it is hold to collect, it means the test has passed. But if it is hold to collect and sell or hold for trading, the test is failed. Okay, just for understanding purposes. And if it is cash flow characteristics, which is based on SPPI, the test is passed. Other than this, the test is failed. Supposedly, there is a hybrid instrument, okay, in which you would be receiving dividend if it is converted into an equity, okay, or it's a participatory security. So the test is failed. We have in fact discussed this thing in the previous slide. That's why I'm just skipping. So this is what we have discussed, okay, in the previous slide. So the model is that if these tests are passed, we will use amortized cost method. And if the test is failed, either we will be using fair value through OCI or fair value through profit loss. We will learn this thing. Convertible loan stock for issuer, these are the liability. We use amortized cost method. And for holder, it is a financial asset for which we will be using fair value through profit loss because the test has failed. Okay. So the financial assets, as I discussed with you, that we are investing in debt securities, debt instruments, or in the equity instruments. So if we are making investment, we, the institute, the business, the entity is making investment in debt securities, like it's a lending or debenture like that, in which you are making investment. So you will see either you would be classifying it as at fair value through profit loss, or at amortized cost, or at fair value through OCI. So at amortized cost method, this will be used when the model is hold to collect and SPPI is there. Okay, contractual cash flow is SPPI. This is the case when debt instrument of other entity is held till maturity. No intention to sell, transaction cost will be capitalized, and interest received, exchange gain, etc. will be recognized in the profit loss. Interest income will be recognized in the profit loss. But if it is held for trading, this investment in debt instrument will be measured at fair value through profit loss. But if it is held to collect and sell, okay, then it will be measured at fair value through OCI. Okay, whereas for the investment in equity instrument, by default, it should be measured at fair value through profit or loss for equity instrument. And by designation, we can measure it at fair value through OCI. This is explained in this slide, that what we do for fair value through profit loss, all the investments that we are holding for trading purposes will be fair value through profit loss, short-term purpose, trading purpose, etc. But if the intention is not for trading in near future, it's a strategic long-term investment, you will designate it for the longer term to be made at fair value through OCI. There is one very important concept that I want to discuss right over here, because we are running short of time. That is that what we do when we dispose of the investment in equity instrument, which is measured at fair value through OCI. The concept is that the difference is taken to profit loss, but there's a conflict in this concept because mostly people get confused over here, because in some books it is written that it should be measured in fair value through OCI. Just remember, it's a very tricky point. Your carrying amount was 40,000 on 31st March 23. Your fair value was 50,000. What you did? You remired it through OCI. You took all this 10,000 through OCI in the equity. On the same date, you are selling it out at a sale proceeds of 48,000. So now you are selling on the same date the investment which you have already remeasured at fair value through OCI, and because of any reason, which could be your means related party transaction, now you are selling it out at 48,000. So that 2,000 will definitely be taken to profit and loss. This is very important. So fair value option can also be used for all the investments, be it like through OCI or amortized cost method. All the investments can be measured at fair value through profit loss, but it would be an irrevocable option. Why we do so? To eliminate the recognition inconsistency, or to eliminate the accounting mismatch. What happens, in fact, you have taken loan, which is a short-term loan, okay, and which is a marketable loan. You, based on that scenario, measure it at fair value through profit loss, this liability. And such loan is you are using for investment, which will be like fulfilling all the criteria of to be measured at fair value through OCI or amortized cost method. But you see, there would be a remeasurement inconsistency. The liability through which the investment was funded is measured at fair value through profit loss, because it is fulfilling the criteria of being measured at fair value through profit loss, whereas the investment is measured at amortized cost method. So standard gives you an option which is irrevocable, that you can remeasure your investments at fair value through profit loss. Okay. So here there are few more points regarding the financial liabilities subsequent measurement, which is to be, by the way, financial liabilities should always be measured at amortized cost method, but there are certain financial liabilities which we can measure at fair value, which include like the derivatives, okay, and there are in fact certain points which is very important over here to understand, that when you are measuring the financial liability at fair value, the fair value which is representing the own credit risk would be taken through the OCI. Rest of the remeasurement difference will be taken through profit loss. And reclassification, I'll say this slide is an ultimate slide in which you will get to know that what is this reclassification. Reclassification is not allowed, in fact, unless the model is changing. So financial asset investment in equity instrument from fair value through OCI to fair value profit loss is not, because the equity instrument was irrevocably designated to be measured at fair value through other comprehensive income. Now we cannot revert back to fair value through profit loss. Okay. So only those can be reclassified if the model is changing. Derivatives can never be reclassified. Liabilities are again can never be reclassified. So this is the only reason when we can say it will be reclassified, and upon reclassification, the difference will be treated when we are going from amortized to fair value through profit loss. This fair value is measured at reclassification date with gain or loss recognized in profit loss. When we are going from profit loss to amortized, this fair value is measured at reclassification date as equal to new gross carrying amount. Okay, and effective interest rate would be worked out. Okay, and amortized cost to fair value through OCI, this fair value is measured at reclassification date. Any gain or loss arising from difference between the previous amortized cost and fair value is recognized in OCI, and the EIR is measured for this ECL, etc. And this is very interesting. From fair value through OCI to amortized cost method, we will work it out as if it had always been measured at amortized cost. And when we are reclassifying from profit loss to OCI, continue measuring fair value, but it will be taken to OCI. And when from OCI to profit loss, we will keep on measuring at fair value, but its difference will be taken to profit loss. So that's all for our discussion today. And in fact, we are done with our webinar, and this is my disclaimer that might be mostly things you would see are taken from other like websites, etc. This is just for the sake of like making the things easy to understand. And this is our business addresses. We are working in USA, UK, UAE, and New Zealand. And you people may contact us for your consulting. Thank you very much. God bless you all. Bye-bye.